Welcome into another daily editorial here on the KE Report. In this daily editorial, I am joined by Jordan Roy-Byrne. He is the founder and editor of The Daily Gold. And Jordan, what I want to do today is focus on the relationship between gold and the U.S. equity markets. I think we all know how low that ratio is in terms of gold being undervalued compared to the U.S. equity markets. But just in the last couple days, actually a couple weeks, there's been a slight shift in this ratio where, who knows, maybe it has bottomed. But when we look at the individual components, which we will do after this, there are different factors at play. First and foremost, though, in terms of the gold and let's go with the Dow ratio, do you think it's bottomed here? Is this encouraging?
Well, I mean, the recent strength, Corey, is definitely encouraging given the fact that the stock market had a sharp sell-off for a few days and that gold pretty much held firm, even though gold stocks and silver were selling off. That ratio surging in the very short term, gold to stocks, I mean, that is favorable for the precious metal sector. It doesn't mean it's immediately favorable, but just in the bigger picture, it is favorable. Has it bottomed? This is the one thing I really wish I knew, and it's just too hard to say. I mean, there's not enough evidence. When I was looking at the S&P against gold, because you can look at there's so many different indices you can use for stocks, and then you could do the stocks divided by gold, or you could do gold divided by the stocks. But when I was looking at the S&P divided by gold, I was hoping that would get up to 2.50, which there were a bunch of things pointing to that as a really strong target. And I think it got up to, I'm just looking at a chart here now, I think it got up to about 2.15. So it didn't really come close to that 2.50 level. But I mean, it's just really hard for me to say, Corey. I could just ramble on and say, well, maybe, I mean, possibly. But the honest assessment I can give is we don't know. I mean, if it's not at a bottom yet, as far as gold against stocks, then it's really, really close. I mean, if it's not at a bottom yet, it's really, really close, and I'd expect it to happen at some point this year. And I mean, there's a chance it may have already happened. So this is something that, I mean, this is a really important ratio, a really important relationship that everybody should be watching. And the reason, Corey, and I know we'll get more into this, is we're not going to see a real big bull market in gold unless it's outperforming the stock market.
And those are some of the aspects that we should cover here. Let's first talk about the stock market because of the big moves. Most of the turn in this ratio, and I now have the S&P 500 to gold, just in the last 2 weeks, has been the big drop in the markets. Again, gold has been relatively muted in its moves. But the stock market, how does it relate to rising rates? Some people argue that rising rates can be good for stocks, but that's not necessarily what your data has shown you.
Yeah, well, I think rising rates can be good for stocks at the beginning of a rate hike cycle when the Fed starts hiking rates, because when do they start hiking rates? Well, usually they start hiking rates in the early to the middle stages of an expansion, probably closer to the middle stages. And that's when the economy is strong. It can obviously handle it. And they're going to start hiking rates at that point. They're not going to start hiking rates when things are weakening. They do it when the economy is strengthening and stocks are performing well. So naturally, even though they increase rates a little bit, naturally stocks can still rise. It's just there's a point when rates and bond yields get to a certain level when they start to hurt the economy, and that's when everything slows down. So, the question is, for the stock market, have we already gotten to the point where rates are going to start to hurt the stock market and the economy? Corey, I would say we're not there yet as far as that. I mean, I think we're getting really close to that point, that threshold. I mean, nobody knows what it is, but my guess is we're not quite there yet, but we're moving much closer to it. And just the idea that rates can rise for two reasons: the economy is strengthening or inflation is picking up. And so if bond yields are rising because inflation is picking up more so than growth, then rising rates are not good for the stock market or the economy. And that's really what we saw in the 70s, really to a strong degree in the 70s. And if you look at what happened and you look at rates and then you look at stock prices, there are several times where stocks bottomed right around the point when rates peaked. I'm not talking about major peaks here. I'm just talking about if you look at, a 5 or 10 year slice and you look at, okay, here are some of the key lows in stocks. What did rates do? The key lows in stocks in the 70s basically came around the time when rates peaked. And so that means when rates were rising, it caused stock prices to sell off. Now, that was true in the 60s, but to a lesser degree. So the correlation wasn't quite as strong in the 60s, and also stock prices in the 60s, if you look at the S&P 500, their ascent slowed down in the 60s, but they still were making higher highs. But at the same time, it was still true that when when bond yields went up, eventually they got to a point where it hurt the economy and stocks, and then stocks would correct, and then rates would turn back down for a little while, and stocks would go up again. So in the early to mid 60s, stocks were still making higher highs, but the ascent was really not that strong. And also, if you look at real terms, gold obviously didn't start trading until 1970 or 71. So if you look at gold stocks relative to the stock market, that ratio, let's say stocks versus gold stocks, that ratio peaked, I think, around 60 or 61, somewhere in there in the early 60s. And also, if you look at stock prices relative to inflation, that I think peaked around 65, 66. So in real terms, the stock market, depending on what you look at, it peaked in the early or mid 1960s. And so, to make a long story short, Corey, that's I think where we could be right now with the stock market. We're not at the ultimate top yet, but we're probably getting closer. And at least if U.S. stocks are going to continue to rise here, the pace of ascent is probably going to be slower. And perhaps in real terms, perhaps they've already peaked in real terms. I mean, that's getting back to the first thing we talked about. Relative to gold, have stock prices already peaked? And I mean, that's the question right now that we're both wondering. And I would say, maybe if it hasn't already happened yet, we're getting very close to that point, which I think would happen at some point this year if it hasn't already.
Yeah, you're not alone, though, Jordan, in saying that maybe these prices haven't quite peaked for stocks, but it definitely was a wake-up call this week and even at the tail end of last week in terms of some more volatility. In terms of, again, U.S. stocks, if we do see that volatility, do you think it makes investors reconsider the mentality of just this passive investing, just putting money into general market tracking funds and forgetting about it? More volatility could mean some more stock pickers, some more sector-specific plays?
Well, I think the professionals in the institutions, they're the ones who will move first. And I mean, they've already moved into, more commodity-like sectors because they can see the threat of inflation. I mean, we had Paul Tudor Jones, who's basically considered one of the absolute greatest traders of all time. He's very bearish on stocks, and he's saying inflation is really going to pick up considerably. So I don't like the term smart money. I'd rather prefer just professionals and institutions, and the likes of those folks. I think they've already looked to move into other areas and areas that can benefit from inflation in a late economic cycle. Unfortunately, the people who do passive investing, who just stick their money in some account and, they're with these new robo-advisors. I mean, those people are not, they're not going to be moving into hard assets or inflation plays anytime soon. Unfortunately, I think those types of investors, they're always the last to act and the last to move. We see that they've been piling into the stock market late last year. And, while over the months ahead, they may make some gains in nominal terms, I think it's going to be very hard to make gains in real terms over the next couple of years, at least in U.S. assets. And so, those types of people, I just don't see them rotating out into our sector, meaning not just gold, but commodities and hard assets. Whereas I would say the institutions and real professionals, I mean, they've already moved some capital into those areas, the areas that we like. Although as far as where we are in that stage of movement, it's still very early because, we haven't seen this major breakout in gold yet. Like, assuming that happens in the second half of the year and gold goes above 1,400, has a really strong move. I mean, that's really going to be when you see a massive move from the institutions and professionals into things like gold and other inflation plays.
Okay, now in terms of gold, let's look at the other side of this ratio. What's it going to take to move gold? Yes, we're seeing, again, higher rates, but we're also seeing some of the inflation data, especially tips showing us that inflation is also picking up. So in your eyes, what's it going to take for the gold market to get moving in real terms?
Great question. My one-word answer would be time. I mean,
that's fair.
I know that I can say a lot and ramble on about the topic, but to boil it down, to make it as simple as possible, I would say time. It's just going to take time. I mean, we're in real terms, we're not there yet. And Corey, that, I think I've already said this, but we know that this move in gold since that December 2016 low around 1120 an ounce, the move up has been great, but it's basically 90% of that move has just been a reflection of the weak dollar. Gold has not performed that well relative to foreign currencies, and in the same time period, it's been trending down against equities. So when we see those things start to change, and I think when we see those things change in favor of gold, that is going to precipitate the breakout in gold. So those things can kind of be a leading indicator. I mean, what do we need to see? I mean, it's so hard to say because, we've talked about this before. We always like to talk about catalysts, but, the market will always price things in before they happen. So I just think it's going to take time. It's going to take more money moving out of stocks and bonds, and a little bit of that moving into gold. And, perhaps we see inflation expectations continue to increase. We see more of that news, and that causes more people to move into gold and other inflation plays. It's just to boil it down, time would be my answer.
Okay. Yeah, it is going to take some time. And again, it's a constructive chart, but without any significant breakouts here, it is just going to take time for people to reassess and reallocate some of their money. Jordan, it's great chatting with you. Thanks for taking time, and I'm chat with you next week. Thanks, buddy.